January 12th, 2026, a date that will be remembered as the day the financial system cracked. While Wall Street displayed $82 on their screens, Shanghai was paying $91, a $7 gap. Between paper promises and physical reality, Samsung is panic buying, Tesla is scrambling for supply, and the Pentagon just realized they have no stockpile. The refineries are fully booked for 6 months. The dealer shelves are going empty. And somewhere in a Manhattan trading floor, a bullion bank just discovered their short position has become a suicide mission. This is not a rally. This is a structural fracture. And what happens in the next 72 hours will determine who survives the greatest wealth transfer in modern history. Welcome to Currency Forensics, where we dissect the financial crime scenes the mainstream media refuses to investigate. Now, if you've made it this far in your life without subscribing to a YouTube channel that actually tells you the truth about money, today might be a good day to break that pattern. That little red button below, it's not going to press itself. And frankly, at this stage of the game, you deserve to know what's really happening to your purchasing power. So go ahead, hit subscribe, consider it an investment in knowledge that no bank can confiscate, and while you're at it, drop a comment below and tell us where in the world you're watching this from. Are you in New York watching the paper price? Or in Shanghai watching the real price? London? Mumbai? Sao Paulo? We want to know. Because what's happening to silver right now is happening to your currency too. Now let's get into what the banks don't want you to understand. On the morning of January 12th, 2026, something broke. Not in the physical world, but in the invisible architecture that holds the global financial system together. The price of silver opened at $80.69, a number that seemed ordinary enough, but within minutes, that number became irrelevant. By 9:47 a.m. Eastern Time, silver had teleported to $84. Not climbed, not rallied, teleported. The chart showed a vertical green line, the kind of line that makes professional traders stop breathing, the kind of line that appears when someone, somewhere, ran out of options. This was not normal price discovery. This was forced liquidation, somewhere in the plumbing of the financial system. A massive entity had been caught on the wrong side of history. They were short at $75, betting that silver would fall. But silver didn't fall. It exploded. And when their risk model calculated their losses, the computer took over. It started buying at $81, at $82, at $83. It didn't stop until it hit $84. This is what panic looks like in the age of algorithms. But here's where the story gets interesting. While New York was celebrating or mourning the $84 print, on the other side of the planet, a completely different number appeared. The Shanghai Gold Exchange, the largest physical precious metals exchange in the world, fixed the price of silver at 91.13. Let that sink in for a moment. 91.13 in Shanghai, 82.79 in New York, an $8 gap between East and West. This wasn't an arbitrage opportunity. This was a confession. The physical market in Asia was screaming a simple message. The paper market in New York is a fiction. When gaps of this magnitude appear, they don't just represent pricing inefficiency, they represent the death of a pricing mechanism. Think about the physics of this situation. If silver is $82 in New York and $91 in Shanghai, every rational trader on earth will do one thing. Buy in New York, ship to Shanghai, collect the $9 profit. They will do this again and again and again until the vaults in New York are empty. This is not theory. This is gravity. You cannot negotiate with gravity. The mainstream financial media tried to dismiss the morning's action. They called it profit-taking. They pointed to the wick at the top of the candle, the brief rejection at $84. They said, "See, the rally is over. Smart money is selling." But they were reading the chart backwards. That wick wasn't profit-taking. That wick was desperation. The remaining short sellers, the ones who hadn't been liquidated yet, threw everything they had at the market. They were defending the $85 level, not because of technical analysis, but because of survival. If silver closes above $85 while Shanghai sits at $91, they become insolvent. Their banks become insolvent. The entire paper derivatives structure collapses. So they sold futures contracts they didn't have. They triggered algorithmic selling programs. They tried to paint the chart red to scare retail investors out of their positions. But here's what they couldn't hide. Despite their maximum effort, despite the massive volume of selling, the candle closed green, the trend remained up, the lows were getting higher. In December and May, when they smashed the price, it stayed down for a week. In January, when they smashed the price, it bounced back in an hour. The suppression algorithm was breaking down, and everyone who understood the market architecture could see it. There's another detail that made January 12th extraordinary. The gap up happened on a Monday morning, not a Wednesday, not a Friday, a Monday. This timing reveals something critical. The pressure built over the weekend while markets were closed. News of the Shanghai premium spread. Industrial buyers panicked. Supply concerns accumulated. And the moment the opening bell rang, all that pressure released at once. This creates a psychological crisis for everyone sitting in cash, everyone waiting for the pullback, everyone who thought they had time. They were waiting for silver to drop back to $75 so they could buy the dip, but suddenly they're staring at $84 and realizing the dip might never come again. This fear, this realization that the train is leaving the station, this is what fuels the next phase. It's called the chase, and it's just beginning. Because while the traders in New York were analyzing charts, a very different conversation was happening in boardrooms across Asia, in procurement offices at Samsung, in supply chain meetings at Tesla, and in secure facilities at the Pentagon. These people don't care about Fibonacci retracements. They care about one thing, making sure the assembly line doesn't stop. And that's where this story gets truly dangerous. There's a phone call happening right now that you'll never hear about, but it will change the price of everything you own. A procurement officer at Samsung, sitting in a glass tower in Seoul, just got an email that made his hands shake. The subject line read, "Silver delivery delayed indefinitely." His factory in Nevada produces 50,000 solid-state batteries per day. Each battery requires exactly 50 grams of silver. The carbon nanocomposite anode won't work without it. Physics doesn't negotiate. He does the math in his head. 2,500 kilograms of silver per day, just for one factory. The contract he signed 6 months ago. Guaranteed delivery at $68 per ounce from a vault in London that supposedly had metal. That vault is now saying, "We're experiencing logistical challenges." Corporate speak for, "The silver isn't there." He opens another tab on his computer, checks the Shanghai Gold Exchange, $91.13. Checks the COMEX in New York, $82.79. And suddenly, he understands what's happening. Every ounce of unallocated silver on the planet is flowing toward that $8 premium in Shanghai, like water running downhill. The metal is leaving the Western Hemisphere, and it's not coming back. He picks up his phone, calls his counterpart at Tesla's Gigafactory. "Are you seeing this?" "I'm looking at it right now. Our supplier just told us 8-week delay." 8 weeks? We have orders for 200,000 vehicles this quarter. "I know." Silence on the line. The kind of silence that costs billions. Here's what the financial news won't tell you. This conversation is happening simultaneously in 12 languages across 43 countries in the offices of every company that builds electric vehicles, solar panels, smartphones, medical equipment, military drones, anything that requires electrical connectivity at scale. And they're all realizing the same thing. At the exact same moment, the just-in-time supply chain is dead. Let's talk about what this means in practical terms. That Samsung executive has a choice. Wait for silver to come back down, or pay whatever it takes to secure supply right now. If he waits, and the price goes to $100, he saved nothing and lost 8 weeks of production. If he waits, and the metal never arrives, his $4 billion factory sits idle. His shareholders destroy him, and BYD in China takes his market share. So what does he do? He calls a mining company in Mexico. Directly, bypassing the COMEX, bypassing London, bypassing the entire public exchange system. "I'll pay you $88 per ounce cash if you ship the concentrate straight to my refinery this week." The mining executive on the other end pauses. "The COMEX is only showing $82. I don't care what the COMEX is showing. I care about keeping my assembly line running. Do we have a deal?" "We have a deal." This is called ghost supply, and it's happening on a scale that would terrify you. Metal that never touches a public exchange, never appears in official inventory reports, never shows up in the data, just vanishes, straight from the mine to the factory to the outside world. It looks like supply is evaporating. But in reality, it's being privatized. Here's the part that breaks the market. Let's do some basic math. A solid-state battery contains 50 grams of silver. At $60 per ounce, that's roughly $100 of silver per vehicle. At $84 per ounce, that's roughly $135 of silver per vehicle. Now ask yourself, does a $35 increase in materials cost stop someone from buying a $55,000 Tesla? Of course not. It's a rounding error. But here's the question that changes everything. Can you build a car without the silver? No, you cannot. This is what economists call price inelasticity. When demand doesn't drop, even when price skyrockets, because the product is non-negotiable. Samsung doesn't care if silver is $84 or $184. They care about one thing: having it. Tesla doesn't care about the price. They care about supply. The Pentagon doesn't care about cost. They care about operational capability. And suddenly, you have Samsung competing with Tesla, Tesla competing with the Pentagon competing with Huawei, all of them chasing the same shrinking pile of metal. And none of them can afford to lose. This creates something terrifying, a floor under the price that no bank can break. In December, when the banks smashed silver down to $67, it stayed down because industrial buyers weren't panicking yet. In January, when the banks try to smash it, it bounces back in minutes because every dip gets bought instantly by procurement officers with billion-dollar budgets. And no other choice, but there's another buyer entering the market that nobody's talking about yet. A buyer that doesn't care about profit, doesn't care about ROI, only cares about survival. The United States military just checked their strategic stockpile and discovered they sold it all in 1998. Now they need it back, and they're about to find out what happens when you try to buy back what you should have never sold from people who now understand exactly how desperate you are. There's a moment in every financial crisis when the secret stops being a secret. It happened on a Tuesday afternoon, January 13th, 2026, at 3:47 p.m., when a 54-year-old schoolteacher in Ohio opened her phone during lunch break and saw a headline that made her coffee go cold. Silver hits 84, biggest one-day move in decades. She hadn't thought about silver since 2011, when her brother-in-law lost money buying coins at $48. She remembered him as the crazy one, the one who talked about conspiracies, the one everyone avoided at Thanksgiving. But $84. She clicked the article, started reading, and 3 minutes later, she opened Google and typed, "How to buy silver near me." She wasn't alone. At that exact moment, 47,000 other people around the world typed the exact same phrase. By 5 p.m., that number hit 280,000. By midnight, Google Trends showed a 340% spike in silver-related searches, the highest since the 2020 pandemic. The secret was out, and once the public knows, everything changes. Here's what separates institutional money from retail money. When a hedge fund manager buys silver, he calculates net present value, risk-adjusted returns, correlation coefficients. He buys value. When a schoolteacher buys silver, she doesn't calculate anything. She sees the price going up, and her brain screams one word: missing out. She doesn't buy value. She buys momentum. And momentum is the most powerful force in financial markets. By Wednesday morning, dealer websites across America started showing messages: high volume, expect delays, limited inventory available, call for current pricing. That last one is the scariest because it means the volatility is moving so fast that automated pricing systems can't keep up. If a dealer sells you a coin at $85 VAR and the price gaps to $92 in 5 minutes, they lose money on every sale, so they turn off the buy button, and suddenly silver becomes unobtainium. A man in Phoenix called his local coin shop. Do you have American Silver Eagles? Yes, but what? The price on the screen says $82, but I'm selling them at $107. That's a $25 premium. Sir, I have 3 coins left, and 47 people called this morning. If you want them, the price is $110. If you don't, they'll be gone in an hour. He bought all 3, not because he understood the gold to silver ratio, not because he studied backwardation. He bought because he was afraid that if he didn't buy now, he'd never get another chance. This is the psychology of a stampede, and stampedes don't care about resistance levels. But here's where most people make the fatal mistake. That school teacher in Ohio, she didn't drive to a coin shop. She opened her stock trading app and bought shares of SLV, the iShares Silver Trust ETF. She thought she was buying silver. She was wrong. There's a moment in every financial crisis when the secret stops being a secret. It happened on a Tuesday afternoon, January 13th, 2026, at 3:47 p.m., when a 54-year-old schoolteacher in Ohio opened her phone during lunch break and saw a headline that made her coffee go cold. Silver hits 84, biggest one-day move in decades. She hadn't thought about silver since 2011, when her brother-in-law lost money buying coins at $48. She remembered him as the crazy one, the one who talked about conspiracies, the one everyone avoided at Thanksgiving. But $84. She clicked the article, started reading, and 3 minutes later, she opened Google and typed, "How to buy silver near me." She wasn't alone. At that exact moment, 47,000 other people around the world typed the exact same phrase. By 5 p.m., that number hit 280,000. By midnight, Google Trends showed a 340% spike in silver-related searches, the highest since the 2020 pandemic. The secret was out, and once the public knows, everything changes. Here's what separates institutional money from retail money. When a hedge fund manager buys silver, he calculates net present value, risk-adjusted returns, correlation coefficients. He buys value. When a school teacher buys silver, she doesn't calculate anything. She sees the price going up, and her brain screams one word: missing out. She doesn't buy value. She buys momentum. And momentum is the most powerful force in financial markets. By Wednesday morning, dealer websites across America started showing messages: high volume, expect delays, limited inventory available, call for current pricing. That last one is the scariest because it means the volatility is moving so fast that automated pricing systems can't keep up. If a dealer sells you a coin at $85 VAR and the price gaps to $92 in 5 minutes, they lose money on every sale, so they turn off the buy button, and suddenly silver becomes unobtainium. A man in Phoenix called his local coin shop. Do you have American silver eagles? Yes, but what? The price on the screen says $82, but I'm selling them at $107. That's a $25 premium. Sir, I have 3 coins left, and 47 people called this morning. If you want them, the price is $110. If you don't, they'll be gone in an hour. He bought all 3, not because he understood the gold to silver ratio, not because he studied backwardation. He bought because he was afraid that if he didn't buy now, he'd never get another chance. This is the psychology of a stampede, and stampedes don't care about resistance levels. But here's where most people make the fatal mistake. That school teacher in Ohio, she didn't drive to a coin shop. She opened her stock trading app and bought shares of SLV, the iShares Silver Trust ETF. She thought she was buying silver. She was wrong. There's a map on the wall of every trading floor in New York, a map that shows resistance levels, support zones, Fibonacci retracements, places where the price should stop. On January 16th, 2026, a senior analyst at Goldman Sachs walked up to that map and drew a red X through it, because when an asset breaks its all-time high, the map becomes useless. There is no resistance above $84, because we've never been above $84. This is called price discovery, and it's the most dangerous phase of any market, because nobody knows where it stops. But here's what that analyst understood, that most people miss. The question isn't, how high will silver go? The real question is, how broken is the dollar? Let's reframe this entire situation through a lens that changes everything. Gold is currently trading at $2,580 per ounce. Silver is at 82. That's a ratio of 31.5 to 1, meaning you need 31.5 ounces of silver to buy 1 ounce of gold. But here's the historical context that matters. For thousands of years, from the Roman Empire to the founding of America, that ratio was 15 to 1. 15 ounces of silver bought 1 ounce of gold. That wasn't arbitrary. That was geology. There's roughly 15 times more silver in the Earth's crust than gold. So let's do the math that terrifies central banks. If gold is at 2,580 and the ratio returns to its natural 15 to 1, silver should be at $172 per ounce, not $82, $172. At the current price, silver isn't expensive. It's on a 52% discount sale. But there's a problem with getting to $172, the same problem that's plagued silver since 1980. Time. The school teacher in Ohio doesn't have years. The Samsung executive doesn't have months. They need answers now, and that's where the exit strategy becomes critical. Because here's what most people get catastrophically wrong. They think the end game is sell silver, get dollars, become rich. But that's backwards. If you sell your silver for dollars, what have you actually done? You've traded a hard asset that's appreciating for a soft currency that's collapsing. You've jumped off the lifeboat and swam back to the Titanic. Because the Titanic has a nicer buffet. Let's learn from history. Weimar, Germany, 1923. A man sold his gold for 1 million marks. He felt rich for exactly 3 weeks, until a loaf of bread cost 3 million marks. Zimbabwe, 2008. People sold their silver for 10 billion Zimbabwe dollars. Those bills are now sold on eBay as novelty items for $5. Venezuela, 2016. Families traded gold for bolivars to buy food. 6 months later, that same food cost 100 times more, and their gold was gone forever. The pattern is always the same. Those who exit into currency lose. Those who exit into assets win. This is called the ounces to acres strategy. And it's the only endgame that makes sense. You don't sell silver for dollars. You trade silver for land, for rental properties, for businesses, for farmland, for energy infrastructure, for things that produce income without requiring permission from a central bank. Right now, a decent house might cost 5,000 ounces of silver, but in the peak of a mania, when silver hits $200, $300, $500, and real estate crashes relative to metals, that same house might cost 800 ounces. That's the trade. That's the moment. When you swap one form of generational wealth for another form of generational wealth, and the fiat currency never touches your hands. But we're not there yet. We're at $82. We're at the beginning, not the end. The week ahead will test everyone's resolve. The banks will launch counterattacks. They'll try to smash the price to $75 to trigger stop losses. To create panic, they'll spread rumors of ceasefires, bailouts, policy changes, anything to shake you out. And here's what you need to understand. If you own physical silver, a price drop means nothing. Your ounce is still an ounce. It still conducts electricity. It still stores value. It's still outside the banking system. But if you're trading on margin, if you're in ETFs, if you're using leverage, a $10 flash crash will wipe you out, and you'll be right about the direction, but wrong about the method, and broke before the destination. The veteran in Dallas who buried his silver, he understood this. He's not checking the price every hour. He's not setting stop losses. He's not worried about pullbacks because he's not trading. He's surviving. There's a phrase that's been whispered in banking circles since Sunday, January 11th. The physics have won. Because no matter how much paper they print, no matter how many contracts they sell, no matter how many algorithms they deploy, they cannot create physical silver out of thin air. Samsung needs atoms. Tesla needs atoms. The Pentagon needs atoms. And atoms don't negotiate. So here's the final strategic assessment. For the business leaders watching this, for the entrepreneurs building companies, for the decision makers managing risk, 3 critical actions. 1, secure your supply chains now. Whatever critical materials you need, lock them in. Price is secondary to availability. 2, evaluate your dollar-denominated exposure. Every contract, every payment term, every debt instrument. Assume the dollar loses 30% of its value this year, and plan accordingly. 3, allocate a percentage of treasury to hard assets, not as speculation, as insurance, against the system we just watched fracture. January 12th, 2026 was not a trading opportunity. It was a signal that the 50-year experiment in pure fiat currency is entering its terminal phase. The gap between paper and physical, between screen price and street price, between promise and reality is now visible to anyone willing to look. The banks lost control, not because they weren't smart enough, but because they were fighting physics. And physics always wins. The repricing has begun, the dam is broken, and the water isn't flowing. It's crashing. Welcome to the age of real money, where your wealth is measured, not by the promises in your account, but by the atoms in your possession. This is currency forensics, where we don't predict the future. We examine the crime scene and let the evidence speak. The evidence is clear. The system broke on January 12th. What you do with that information will determine whether you're preserved or erased in the great repricing ahead. Stay sharp, stay liquid, and above all, stay physical. Subscribe to Currency Forensics, because the next crime scene is already forming, and you deserve to see it before it's too late. Claude is AI and can make mistakes. Please double-check responses.